We have some viewer mail this week.
Oh, great. If you would like to ask a question, please send it to Doug@riskandrewardtv.org, and I will do my best to answer your question. What do we have?
And this is from Dave in Placerville, California.
Hi, Dave.
Hello there. And he says, what happens if we don't raise the debt ceiling? And how can we keep on spending?
Well, that's a good question. I really like that question. It's absolutely true that the debt ceiling is a big issue right now, and we do need to control spending, and we're kind of in a catch-22. The new Bloomberg Business Week addresses it, and I got a picture of the cover here that says, "Don't play chicken with the debt ceiling." And so,
chicken on the cover.
Yeah,
Look out.
It's got a chicken on the cover, which should tell you everything you need to know about the problem. It is a big problem. The debt ceiling is the maximum that the Treasury can borrow. We've talked about this before. It's the maximum Treasury can borrow. And if we hit the debt ceiling and we need to borrow more to fund our bills, we're essentially in a technical default. Now, in the short term, we can modify that. We can not pay some bills, or we can borrow from other accounts and stuff. But over the long term, that's not going to last. So we do it for a couple months, maybe even longer than that. I don't know completely all the details, but it can't last for long. Eventually, we have to either borrow the money and pay our bills, or we have to increase taxes and pay our bills, or we have to say we aren't going to pay our bills.
That would be the worst.
Well, yeah, so that would be the worst.
That's the chicken part.
That's the chicken. Yeah, so that's part of the chicken part. So what the main worry is, and what this article, and there's another article here from Bloomberg on the same information, that says that the issue isn't so much the debt ceiling itself, it's the impact that it would have on the bond market. Now, do you know what a bond vigilante is?
Oh, yes.
A bond vigilante is what they're terming a bond vigilante is the bond market has a bunch of vigilantes in it that are essentially going to make you fiscally responsible by not lending you any more money at current interest rates.
They've cut up your credit card, and now you have to pay more.
That's right. So Greece
You have to go to a bookie.
That's right.
If the bank won't lend you money, then you go to the loan shark, which
shark
charges much higher interest.
That's right, exactly. So your AAA credit is gone. Now you got to go to Tony Soprano, and Tony Soprano tells you, well, I
tell you what I'm going to do for you.
Yeah.
I'll charge you 25% interest. And
the interest rates in Greek 2-year bonds were almost 18%. So now think about this in terms of house loans. Who's going to buy your house if they got to have a 22% mortgage? Nobody. That's crazy. So we don't want to go the way of Greece. We absolutely want to maintain our AAA credit rating. And so this article here from Bloomberg says, don't play with America's full faith and credit. And so there are people in the market, including me, that would love nothing better than to not mess with our credit rating. We definitely have to deal with our fiscal issues, but let's not lose our AAA credit rating because we're mad at each other. That's not a good idea. So in the long run, if our budget that we just agreed to, both parties agreed to,
yes,
is
for 6 months.
Well, okay, but it's the whole year. We spend more money than we bring in. And so because we spend more money than we bring in, we have to borrow it. And so we have to borrow it. We don't have any choice. Now, there's some political wrangling, of course, that wants to go on here, but we don't want to mess with the bond market because the bond market gets a whiff of we're not going to pay our bills, and they'll start raising interest rates. And once that gets going,
it's wildfire.
It could be very harsh to turn it around. It could be very difficult. So we don't want to get things out of hand. We want to make sure our full faith and credit stands at AAA credit, because right now, what's the 10-year at? 3.5%?
Yeah.
Well, imagine the 10-year at 13%. I mean, obviously, it wouldn't go that high.
So lock in your low interest rate.
Yeah, if you got an adjustable rate loan,
right now,
you're not going to like it if the interest rates start rising up. So that's the fear, is if you start messing with the credit of the United States, interest rates rise. If interest rates rise, it could be very, very painful, and it would be a self-inflicted wound. We'd be cutting off our nose to spite our face, since we don't have to do this. So.
And what's your takeaway?
So the takeaway is, eventually, they have to shut things down or increase revenues. So, but that's not the problem. We're risking the AAA credit. and the full faith and credit of the United States is on the line, and that will have an impact in the bond market and interest rates, and we can't risk that.